JP Morgan says gold goes to $6,000. Bank of America agrees. And gold is sitting at $45.40 an ounce as we speak. Do the math. That's a 32% upside from here. In 12 months. If they're right and the structural data is screaming that they are, this is the asset you do not want to be underweight going into the back half of 2026. But here's the thing. Targets are not arguments. So in this brief, we strip the bank reports apart, look at the chart in cold light, walk through every bull driver and every bear driver, and end with 3 scenarios and a probability map. By the end you'll know which level decides everything, what has to break for the 6,000 call to be real, and what would kill it. No hype. Just signal. Let's get to it. As of today, May 19, 2026, spot gold is trading at approximately $4,540 per ounce. That number is down from the early year highs near $4,800. So we're in a corrective phase. Not a top, a correction inside an ongoing structural bull market. That distinction matters a lot. In the past 12 months gold has run from the mid-3,000s to the high 4,000s. Even after the recent pullback, the yellow metal is up roughly 25% year over year. That is one of the strongest 12-month performances in modern history. And silver, the louder cousin, just punched through $80 an ounce for the first time, with Bank of America forecasting an $86 average for the year. The precious metals complex is moving together. Read that signal. So that's the snapshot. Gold at $45.40, in a correction, inside a bigger bull. Let's open the chart. Start with the daily chart. The question we need to answer is simple. Is this a healthy pullback or a trend reversal? FX Street, in their 2026 gold outlook, put it perfectly. Quote, higher highs and higher lows remain intact, and as long as price holds above the 4,300 region, pullbacks continue to resemble reaccumulation, not distribution. End quote. That single sentence frames the entire technical picture. Higher highs, higher lows, that is the textbook definition of an uptrend. And 4,300 is the line in the sand that separates a healthy correction from a real break. As long as 4,300 holds on a weekly close, the multi-year bull structure remains intact. Lose it on conviction volume, and the entire thesis comes under review. Now the actual levels. Memorize these, they're the entire trade map. Immediate resistance, 45.80. A clean break and we open the door to 46.10 through 46.20. Above that sits the moving average cluster, the 20, 50, 100, and 200-day simple moving averages are stacked between 46.49 and 47.94. That's a wall. Get through it, and the path to 4800, the psychological resistance and the recent high is wide open. On the downside, immediate support sits in the 4400 to 4500 zone. That's the confluence of the rising trend line and prior consolidation. Below that, the next support shelf is 4466 down to 4423. Lose that, and the bigger structural support at 4300 becomes the line of last defense. So the trade map is clean. Above 4580, momentum returns. Below 4400, caution. Below 4300, the thesis breaks. Momentum check. The 14-day RSI on gold is currently at 40.6. That's lower neutral. Softer momentum, but nowhere near oversold. Why this matters? 40 on the RSI tells you the rally has cooled, the speculative froth has come out, and the chart is no longer in nosebleed territory. From here, mean reversion to 50 is a low-friction move. That's exactly the kind of setup buyers want. The moving averages tell the same story from a different angle. Price has slipped below the short-term 20-day SMA. That's the source of the soft momentum reading. But the longer-term averages, the 100 and the 200-day, are still rising. The big trend hasn't rolled. Translation: the pullback is real. The trend is not broken. Buyers should be waiting, not panicking. Technical verdict: the chart is constructive on a multi-month frame, neutral to bullish on the daily, and corrective on the immediate. The structural higher high higher low pattern remains intact above 4,300. The fact that gold is consolidating between 4,400 and 4,600 instead of cratering after a 25% annual run is a tell. Strong assets correct sideways. Weak assets correct downward. Gold is correcting sideways. So the chart says base is forming. The next directional move is more likely up than down, with the catalyst being any one of the bull drivers we're about to walk through. But before that, a quick word. If this kind of breakdown is useful, hit subscribe and like. We publish one of these every week on the asset that matters most that day. Free, no fluff, no hype. Now, the bull case. 3 pillars hold the bull case up. Bank targets, demand structure, and the macro backdrop. Let's take them one at a time. Pillar 1. Wall Street targets. JP Morgan, in their May 18 update, maintained their year-end target of approximately $6,000 per ounce. They did trim the full-year average forecast from 57.08 to 52.43, but read what that actually says. Lower average. Same peak target. That math only works if the second half of 2026 is dramatically stronger than the first half. JP Morgan is explicitly calling for demand to re-accelerate into the back half of the year, with central bank buying and safe haven flows leading the charge. Bank of America. May 1st update. They held firm on a 12-month $6,000 gold target, and pegged silver at an $86 average. When two of the biggest sell-side desks on Wall Street converge on the same $6,000 number, that is not a coincidence. That is a thesis. And it doesn't stop there. ING's Manthe called for 5,000 by year-end. The Reuters consensus poll of 31 analysts came in at 49.16 median for 2026. Pierre Lassonde, co-founder of Franco-Nevada and one of the most credible voices in the gold space, has talked about a 17,250 long-term target, driven by the $40 trillion US debt situation. Every single major target is above where gold trades today. Every single one. That is the Wall Street consensus signal. Pillar 2. Demand. And this is the structural one. The World Gold Council reported that central banks added 244 tons of gold to reserves in the first quarter of 2026. That's up 17% quarter-on-quarter. Let that sink in. Despite the price being near record highs, despite the volatility, despite all the noise, sovereign reserve managers added gold at a faster pace than the previous quarter. That is conviction buying, not opportunistic buying. They are not waiting for a dip. On the institutional side, gold-backed ETFs returned to inflows in April, $6.6 billion added, lifting holdings by 45 tons. After the March sell-off, the smart money came back fast. The World Gold Council is forecasting central bank and investor demand averaging 585 tons per quarter through 2026. That's a sustained, structural bid under the market. Not a one-off panic flow. Pillar 3. The macro backdrop. And this one is the slow burn driver, the kind that doesn't move price on any given day, but reshapes the asset class over years. FX Street put it cleanly. Quote, geopolitical tensions, trade fragmentation, and political uncertainty are no longer shock events. They are persistent features of the macro landscape. End quote. Translation. A permanent risk premium is now embedded in asset pricing. And gold, historically, is the cleanest expression of that premium. It performs best when risk is unresolved, not when risk is acute. The world right now is exactly that, unresolved. Add to that the macro overlay. The US dollar is contested. Real yields are capped. The global de-dollarization trend continues. The $40 trillion US debt pile, the number Pierre Lassonde keeps pointing to, is the structural problem that gold is the cleanest hedge against. And on top of that, currency debasement, Iran war safe haven flows, ongoing reserve diversification by non-Western central banks. Every one of these vectors is bullish for gold. Every one. And they all compound. Now let's be honest about the other side. 3 headwinds the bull case has to fight through. Bear case 1. Rising US Treasury yields and a resilient dollar. Gold pays no yield. So when 10-year treasuries pay you 4 and change % risk-free, the opportunity cost of holding a non-yielding asset rises. JP Morgan flagged this directly, quote, "Gold has proven sensitive to shifts in real yields and dollar strength, both of which remain unsettled." End quote. And the first half of 2026 has shown exactly this stress. JP Morgan trimmed its full-year average from 57.08 to 52.43 precisely because gold has underperformed against their original H1 2026 thesis. That underperformance is the bear case in action, yields and dollar pressure capping the rally. If the Fed stays cautious on cuts because inflation remains sticky, and Fed Williams has said inflation is persistently above target, the yield headwind doesn't go away. The bull thesis requires either lower yields or a weaker dollar. Right now, we have neither. Bear case 2. And this one is the most counterintuitive, the Iran war paradox. Conventional wisdom says war equals gold up. And short-term that's mostly true, safe haven flows ignite, central banks accelerate buying, money moves into hard assets. The chart will spike on every escalation headline. But there's a second-order effect that bears use against gold. The Iran war drives oil higher, Brent at 111, WTI at 107 as we speak. Higher oil means higher headline inflation. Higher inflation forces the Fed to keep rates elevated longer. Higher rates mean higher treasury yields. And higher yields are gold's most reliable enemy. So the Iran war is both bullish through safe haven demand and bearish through the rate channel. The Debasement group put it well, quote, "The outlook for gold prices remains constructive despite the headwinds posed by the war in Iran." End quote. Read that carefully. Constructive despite headwinds. Translation. The bull case still wins, but the war is slowing the move, not speeding it up. That nuance is the difference between a thoughtful brief and a hype reel. Bear case 3. The micro-level cracks that have already shown up. The March sell-off happened. Central banks were net sellers in March, briefly. ETF outflows stacked up. The drop from the early year 4,800 highs to the current 4540 zone is the visible scar of that period. On the consumption side, India, historically a top 2 physical gold consumer, has been dealing with import issues this year. Haraeus flagged it specifically as a near-term drag on physical demand. When the wedding season buyer in India steps back, the spot market feels it. And there's the analyst dispersion risk. While the bulge bracket consensus is bullish, some analysts are calling for gold to trade sideways through year-end. Others see prices falling further before any rebound. That dispersion is not a death sentence, but it's a reminder that the bull case is not unanimous, and a hot data point or two could shift the consensus. If the Fed pivots hawkish, if Iran de-escalates faster than expected, or if real yields blow out, gold could revisit the 4,400 shelf and pressure the 4,300 line of last defense. That's the bear path. 3 scenarios into year-end 2026. Bull case. Gold reclaims 4580 on rising volume, breaks through the moving average cluster between 4650 and 4794, and accelerates toward 4800. Second half demand reacceleration plays out as JP Morgan calls for. Year-end target zone $5,500 to $6,000 per ounce. Probability, call it 45%. Base case. Gold consolidates between 4,400 and 4,600 through summer, then resolves higher into Q4 as yields ease and central bank demand reaccelerates. Year-end zone 4,900 to 5,400. Probability 40%. Bear case. Gold loses 4,400 on conviction volume, breaks the 4,300 line, and revisits the 40,000 to 4,300 zone as yields blow out and Iran de-escalates faster than expected. Year-end zone 4,000 to 4,500. Probability 15%. Net of all three, the probability map tilts bullish. 85% of the distribution sits at or above current price. That is what the consensus, the structure, and the demand picture together imply. Bottom line. This brief leans bullish. The chart is correcting sideways above structural support. The bank consensus is converged at $5,000 to $6,000 by year-end or 12 months out. Central bank demand is structural and accelerating. ETF flows are back. The macro setup, debt, debasement, geopolitics is the cleanest gold backdrop in a decade. The headwinds are real yields, dollar, Iran war second-order effects. But they slow the move, they don't kill it. So watch four numbers. For 580 as the bull trigger. For 400 as the first warning. For 300 as the line of last defense. And 6,000 is the year-end target if everything goes the way Wall Street says it will. The risk you face in this market is not being too long gold. It's being too short. 5 sources powered this brief. JP Morgan via Investing Live. Bank of America via Kitco. The Devere Group, Yahoo Finance, and FX Street. All linked in the description below. If this saved you research time, hit subscribe. Drop a comment with what asset you want broken down next. And if you have a view bull or bear, share it. The best ideas in the comments make every next brief better. No hype. Just signal. See you in the next brief.